The time for the US to start loosening its monetary policy is approaching. It's not just the calendar marking the dates, but also macroeconomic reports that are pushing the Fed toward this step. The macroeconomic reports indicate a cooling economy, which needs to be slowed down in time. Otherwise, the country risks sliding into recession. In the event of this, a lot of indicators will collapse, namely prices, demand, and production. Currently, it's still too early to talk about such a grim scenario. For example, US retail sales did not change in June. Nevertheless, the forecast for the Fed's rate cut in September is almost certain and already priced into asset values. Moreover, expectations of 2 more rate cuts by the end of this year in the United States are growing. Consequently, the 6-currency pair currency dollar index started the trading day around 104.2 points, close to its April lows. Meanwhile, the US dollar continues to get some support from the so-called Trump trade. The fact is that Trump's chances of entering the White House surged after a failed assassination attempt. In this case, his populist reforms will undoubtedly lead to the rise in inflation, which will automatically boost the US dollar. Now, let us look at the macroeconomic reports that traders should take into account at the end of this week, July 18 and 19. You are watching Traders Calendar. As mentioned, a decline in demand for goods and services is very unfavorable for the economy. This applies not only to domestic consumption but also to exports. Notably, the combination of exports and imports determines the trade balance, which may reflect either a surplus or a deficit. For example, Japan reports a considerable surplus, meaning purchases exceed sales. The upcoming data is expected to complicate the situation even more, predicting that in June, Japanese exports will decrease by half to 6.4% from 13.5%. If this happens, the already weak currency will slide even deeper. On Thursday, markets will receive reports from Europe that will help determine the positions of the British pound and the euro. Thus, the United Kingdom will issue its labor market data. Earlier, the number of people in work shrank by 139,000. The fresh data may show a jump to 40,000. In this light, the pound sterling may gain in value, thus boosting the euro. For the single currency, Thursday, July 18, could be a day of either triumph or total defeat. Everything depends on the ECB's decision. It's highly possible that the key rate will remain unchanged. However, the subsequent press conference and especially the comments provided by Christine Lagarde could affect market sentiment, and these events will take place after the key rate announcement, so the euro will face a highly volatile day. On the same day, the United States will disclose its initial jobless claims data. This indicator, published weekly, influences the US dollar, increasing unemployment and a cooling labor market could signal a recession risk, which we have already discussed. Confirmation of a rise to 225,000 will be a negative signal for the dollar, which may cause a decline in the currency. However, the negative impact of the labor market indicator may be neutralized by the manufacturing PMI figures. If the index climbs as anticipated to 2 points from 1.3, it could offset the negative effect. Unlike a busy Thursday, Friday's macroeconomic calendar looks calmer. Significant reports include Japan's inflation and Germany's producer prices. Note that these countries swept places in the global economic ranking based on 2023 GDP growth. As a result, Japan fell to fourth place largely due to the weak yen. Even the inflation growth rate of 2.8% will hardly support the yen, and it may react either neutrally or fall deeper. The euro might be more fortunate. Although the German producer price index has been in a negative area since July last year, it's unlikely to exit this zone. However, the reading of a minus 1.6% is better than a minus 2.2%, and thus the euro might get a boost even from a negative figures. We will monitor the market reaction to the above-mentioned reports. Subscribe to our channel and follow changes in market sentiment with us. Any comments, questions, and offers are welcome. We wish you profitable trading and see you soon.